First, let's talk, obviously, about energy and perhaps this idea that there is some disruption in Russian oil and or gas exports, or maybe countries start to hoard oil or gas on concern that perhaps there will be a supply disruption. What is your view?
Well, I think it goes back to the point you emphasized, is that these markets are incredibly tight right now. And it doesn't take much of a disruption to create ripple effects across all these markets. You know, we like to say it's the persistency of transitory shocks. So our base case is we don't see any significant disruption in either oil or gas or energy flows. I like to point this out. The only time you've ever seen significant disruptions in the flow of energy between Russia and Western Europe was in 1941 when Germany invaded Russia. It just doesn't happen because it's a mutually assured destruction. That said, that doesn't rule out the potential for a few-day disruption or the unintended consequences of an accident. The markets cannot deal with that kind of disruption, and that's the type of dynamic that we think the market's currently pricing in. And it may be, it could be Ukraine, Russia, it could be weather in Brazil on the grains. All these markets are incredibly exposed to any type of disruption.
So how much, Jeff, then, if any, perhaps, in the 93 and change oil price here, 94.5 for Brent crude, how much of that is just a pure risk premia right now? If any, maybe it's zero.
I mean, there's obviously in Friday, given the rally of a few dollars a barrel, we would put it at fundamentally being worth about $2 a barrel. Clearly, there was that impact on prices on Friday. But again, our target from a fundamental basis is $105 a barrel, which is higher from here. And if you did have a disruption of any significant size and this market needed to rebalance sooner, this market could spike as high as 125. So a lot of this is really fundamentally driven, and it's not isolated to oil. We see it across the entire commodity complex because all these markets are severely depleted in terms of inventory, spare capacity, and this is on top the inability of supply to respond to higher prices.
And so this is sort of the difficult Hobson's choice that we may be in, which is if Russia does incur military action, invasion, whatever you want to call it, into Ukraine, and we or the Western world slap sanctions on them, is it possible that that super spikes the price of oil and or natural gas, even in the short term, Jeff, because of those sanctions, thus perhaps hurting the American or Western Europe economies?
Yeah, but when you look at the underlying tactical case for commodities right now, it's rarely been stronger. Let's just look at the setups. Remember, commodities are spot assets. They do not respond to expectations in, financial market, equities and bonds. They're basically anticipatory assets. They respond to the talk of rate hikes. Commodities do not. And let's look at the setup right now. You have real Fed funds rate, minus 7.5%, lower than what it was in the 1970s. M2 growing 13.5% year over year right now, twice what it was in pre-pandemic era. Oil demand in the U.S., 22 million barrels per day, highest ever. And it doesn't look like it's coming off seasonally because people are now moving towards an endemic, and you're seeing that big pop in activity. Look at China. The TSF number, they're stimulating right now. It was the largest on record. They're offsetting weaknesses in the property market. And then finally, look at Europe. Europe is finally distributing the recovery fund, and you're likely to see the most rapid growth in Europe since, in the last 13 years, stronger than the U.S. So let's put this all together. The macro backdrop for commodities hasn't been this strong.
Price is already high, and we're talking about the U.S. and Europe, to your point, and now China stimulating and adding more dollars to the global market. And it's not just oil and gas, Jeff. We talked about the price of wheat, but I look at also things like the price of aluminum and platinum and palladium and copper, these industrial metals for the most part. They are at 20 or 30-year highs in many cases, and demand is off the charts. These are the real inflationary items that we don't talk about enough. I mean, pretty much everything we want to make has either petroleum, copper, or aluminum in it, period.
Yep, period. And that's why those three commodities that you just pinpointed are the best hedges against inflationary pressures. And we again like to argue this. Even the strategic case for commodities has never been stronger. They're a great hedge against inflation. You got negative correlation with the equity markets, and they're a hedge against geopolitical risk, not to mention they're the best hedge against rising interest rates for all the reasons we just discussed. And I think, the case right now for commodities, both tactically and strategic, couldn't be stronger.
So investors in our global audience right now, Jeff, are facing, let's just button this up, two things. Longer term, you've got central bank tightening, not just here, the Fed, but ECB perhaps. We'll see what happens in China. They look like they may be going the other way. But either way, a likely tightening path here in the United States. And, of course, this Russia-Ukraine risk, which that hopefully will be transitory, if you know what I'm saying, Jeff. Mm-hmm. Those, sort of that two-headed hydra, you think that metals, those types of investments are good hedges against one or both?
From both. But I would argue oil is historically the best because it's got that positive skew to the upside, particularly given how low inventories are and the fact that spare capacity is nearly exhausted, which means the upside risk in oil is more skewed to the upside. And that's what gives you the diversification against your equities. One last point I want to emphasize here, you mentioned about Europe, is that these rallies that you're talking about have occurred in the context of a strong dollar. What happens if European interest rates go positive? You get a bid in the euro, the dollar begins to weaken. This becomes a tailwind to commodities. So, again, you got a lot of tailwinds on the commodity complex right now.
Any scenario, Jeff, you see where oil here and Brent crude, maybe they're a couple bucks ahead of us, doesn't hit 100?
Yeah, I think the big thing we're watching, and I think the market's watching, is an Iranian deal. There's a lot of focus on it in the current context. Particularly given what's going on with the inflation numbers in the U.S. We'll see what happens, and I would even say coming weeks. But that is the one lever that can be pulled to create some relief for this market. But I want to emphasize it's just temporary relief. It doesn't solve the longer term problem. And a lot of those Iranian barrels are already in the market. I like to emphasize China is taking 2 times the level of oil today than what it was under the JCPOA. So a lot of that oil is already in the market.